Hello everyone. I'm sure you all are done with your preparations. So now is the time to discuss the debrief of your pre-March mocks for your taxation paper. So let's start right away with question number 1 of section A. Question number 1 of section A is Zephyr Limited holds 80% of the share capital of Quiver Limited and 60% of the ordinary share capital of Gale Limited. Quiver Limited holds 85% of ordinary share capital of Breeze Limited. Now we know we have to use pen and paper, and only on that we will do the workings and of course use calculators. Nothing else you would need for section A and B. To do these type of questions, create the flowchart quickly. So we have Zephyr Limited holds 80% of share capital of Quiver Limited and 60% of the share capital of Gale Limited. Now Quiver Limited holds 85% of share capital of Breeze Limited. When we see this relationship, quickly let's see the question what it wants to ask. Select whether Breeze Limited and Gale Limited would be a part of the group relief group and or chargeable gains group with Zephyr Limited or not. So for before I pick up anything, I think it's needed for establishing the relationship. What is the relationship that we need when we establish the group relationship? Number one, the direct relationship between the parent and the subsidiary has to be minimum 75% or more, and the indirect relationship between the main parent and subsidiary has to be 75% or more. When it comes to CG group, then the direct relationship is needed again 75% or more, but indirect relationship will be needed to be minimum 50%. So let's quickly see. When we see the relationship with Zephyr and Quiver, it is 80%. That means Zephyr and Quiver are 80% have the holding, so they are a part of the CG group. Now, Gale is not a part of the CG group because the direct relationship is not 75%. Also, it is not a part of the main group also, as again minimum 75% direct relationship is not met. So for Gale, I will select neither group. Now, when I go to Breeze, Breeze is a subsidiary of Quiver. So now, when you see the indirect holding of Zephyr into Breeze, it is 80 multiplied by 80%. 80 multiplied by 80% is 68%. Now, how do you determine the relationship? The direct relationship between Quiver and Breeze is 75% or more. Since this criteria is met, only then we go to the next criteria. Indirect relationship is around 68%. So this is not creating a group relationship. However, since it is more than 50%, it is creating the CG relationship. So it is going to be part of the chargeable gains group only, Breeze. Done? Clear? You got 2 on 2. So what is needed here to be very clear about the direct relationship and indirect relationship? Let's go to the next one. For the tax year 24-25, Ethan Limited made a trading loss of 97,000, had an employment income of 12,000. For the tax year 23-24, that is the previous tax year, they made a trading profit of 20,000 and an employment income of 75,000. How much of the 97,000 trading loss could be set against Ethel's total income for the tax year 23-24? For this, number one, against trading income, we can adjust full loss. So there is a trading profit of 20,000 that will be adjusted in full. Against the remaining income, we have a capping of 50,000 or 25% of the total income. Right, 25% of the total income will be whichever is higher. Correct? Now here, the previous year total income is employment income plus trading profit, which is 95,000. 95,000, 25%, please calculate, and that will be equal to 23,750. Now 23,750 or 50,000, which is higher, 50,000. So the maximum loss that we can adjust against the previous year is 50,000 for other income and 20,000 for trading profits. In total, 50 plus 20, 70,000. Great. Okay, so we select here 70,000. Moving on to the next one, Lucy made a gross personal pension contribution of 85,000 for the tax year 24-25. Her adjusted income for the year was 290,000. We know the cap. We know the tapering starts from 260,000 onwards. Remember, and she has no unused allowances brought forward. What is the annual allowance that Lucy will have for the current tax year? So let's calculate. Now 290,000 is the adjusted income. What is excess over 260,000? It is 30,000. 30,000 multiplied by 50%, it becomes 15,000. Correct? Excess is 30. 50% of it is 15,000. So 15,000 is then the amount that will taper AA. What is the AA allowed? 60,000 for the year. Less 15,000, it will taper my AA. But, right? So what is 60 minus 15? 45,000 is the annual allowance allowed. Correct? 45,000 is the allowed annual allowance. The question is not asking what is annual allowance allowed for the year. The question is asking what is the annual allowance charge that will be added to Lucy's taxable income. As you see, so for that, we have to first see what is the excess amount of contribution. We have just calculated that the annual allowance allowed would be 45,000. Gross personal pension contribution is 85. So what is the excess, my friends? 40,000. Very good. 40,000 is the excess. And on this, we will create the annual allowance charge. Okay, so my answer is not 45. Don't do the mistake. It is 40. Let's go to the next one. As you can see, I'm doing no workings on the screen. The reason being, now I want you all to be getting used to doing the workings on the pen and paper with the pen and paper and calculator and do it in a quicker way. Okay, so let's try to do these questions like this in a quicker way. Now, Carlos submitted his self-assessment self-assessment tax return for the tax year 23-24, that is the previous tax year, on 5th October 25. The total tax due was 3,200. What is the maximum late filing penalty that Carlo could be charged with? What is the maximum? Now we know that we will have the initial penalty, then we will add 10 per day for maximum 90 days, and then we will add the percentages. Okay, so let's do the calculations here. But now before we move forward, we need to be knowing and we need to be understanding what is the delay. What was the due date till which the return should have been filed by 31st January 2025, but now it has been filed on October. In October. So what is the delay period? 0 to 3 months, 3 to 6, 6 to 12, or more than 12? 6 to 12 months. Now what is the penalty applicable here? First is a flat penalty of 100. So first I will write 100 here. Then with this I will add the penalty for 3 to 6 months, which is 10 per day for a maximum 90 days. Since it is going beyond 6 months, so it will also have this penalty of 10 into 90, which is 900. Then with this, we add higher of 5% of the unpaid tax or 300, whichever is higher. Now here, unpaid tax is 3,200 given to you. 3,200 multiplied by 5% is 160, or 300, whichever is higher. Which is higher? 300. So 300 is my next penalty. Add everything, how much you get? 900 plus 100 plus 300, 1,300. Very good. And this is your penalty amount. Okay. This will not be given to you in the exam, so you need to remember these slabs. And for that, you know that I have already given you all access to my tax rates and penalties chart, which includes due dates, penalties, everything at one place in one file. In case if you don't have it, please go to my Telegram channel. The link is there in the description and get the file for you today only. Okay, let's go to the next one. So we are doing Vlad is self-employed. His total tax liability for the tax year 23-24 was as follows. Income tax 8750, class 4 NIC 1920 and CGT. What is the amount of each of Vlad's payment on account for the tax year 24-25? That's pretty easy. We will not take chargeable gains into account. We just take income tax, class 4 NIC, add the 2 and divide by 2 because each POA is the equal one, right? There are two POAs. So we will add 8750 plus 1920 divided by 2. I get here, wait, 8750 plus 1920. Total I will get divide by 2. I get here 5335. Simple. This is my answer. Done. 30 seconds. Let's go on to the next one, guys. Come on. I'm sure your energy levels are super high now. And I'm sure you're finding it very comfortable. Okay, let's go to the next one. The next one is Y had the following incomes and gains for the tax year 24-25. Employment income is 47,000. Chargeable gains on the disposal of the building is 8,500. What is Y's CGT for the tax year 24-25? I think it's pretty easy. So what I will do is I will write, we just have to write the CGT. So employment income is given to you so that you calculate the taxable income and then see what is the BRB remaining. That's the only touch point here. So let's calculate. Taxable income will be 47,000 less 12570. That will give me 47,000 less 12570, 34430. Now you know you have a BRB till 37,700. So you still have some BRB left. Let's calculate what is BRB unutilized. So BRB unutilized will be 37,700 less 34430, which is 3270. So 3270 will be taxed at a lower tax rate and more than 3270 will be taxed at a higher tax rate. Now here it is the disposal of a building, of a painting. So the tax rates applicable is 10 or 20. Clear? Very simple. Chargeable gain arising is 8,500. No losses are there, but we will give AEA. So 8,500 is the gain less AEA of 3,000. You get here 5,500. Out of 5,500, now we have just discussed 3,270 will be taxed at 10%, that is the unused BRB, and the remaining of 2,230 will be taxed at 20%. Just calculate the tax, add the 2 and you get your answer. So 3,270 multiplied by 10% is 327 and 2,230 multiplied by 20% is 446. Add the 2, 327 and 446 and you get here 773. So your answer is, my friend, 773. Done. I'm just showing you the speed with which you have to answer. So use your pen papers very effectively, your paper for rough work. Okay. Now let's go on to the next one, guys. Zeta Limited has a corporation tax liability of 728,000 for its 7-month accounting period that ended 31st July 2024. Zeta Limited is a large company and has paid its corporation tax by installments for several years. Okay, so it's a large company. Click on the relevant boxes below to indicate the due date and the amount for the first installment for Zeta Limited. So what is the day of first installment for Zeta Limited? Okay, let's calculate this. Now you know 14th is the date, but since it is a large company and it's a short accounting period, first installment is always due on the 14th of the 4th month, right? Remember the clause carefully. It's 14th of the 6th month, right? Yes, remember it very well. 14th of the 6th month. Now what is the 6th month from the start of AP? From the start of AP we will take 7-month period ended on July. So first month is January. 14th of the 6th month will be from the start of AP, right? So it will be January, February, March, April, May, June. No, my bad. 14th of the 7th month. Yes. See? So we have to remember every time all the clauses. 14th of the 7th month. 7th month is July only. So the due date would be 14th of July. Clear? So this is very clear. And what is the amount of the first installment? Is the equal. 3 equal installments we'll pay, right? 3 equal installments. So that would be 728,000. How do we calculate the equal installments? You not do simply divided by 3. What is the formula? You take the tax amount, which is 728,000, multiplied by the number of installments which are equal, which are 3, divided by the total period of this first account of this accounting period, which is 7. So you will do 728,000 multiplied by 3 by 7. I get the amount as 312,000. This is the amount of my first 3 installments, and then any amount remaining will be paid by way of a balancing payment. Okay, within 4 months from the end of AP, and the 3 dates are the 7th month from the start of AP, 10th month, 13th month, and post that 4 month from the end of the AP. Correct? Okay, so my amount is 312,000 and the date is 14 July. Okay, let's go to the next one. So you've till now we have been able to do the questions quite quickly, and the same speed we have to maintain. Remember, 1.8 minutes per mark is the maximum time that you have to devote. Now, Damon started his business on 1st July 23. His sales exclusive of VAT were 9,000. Okay, now for the first 3 months. So that means it is a question something around registration. For the next 3 months, monthly sales increased to 10,000 and then 11,500 for the month thereafter. From what date? From what date Damien will have to charge output VAT? So let's start from here only. Let's take 3 months this, then 3 months, and then next 3 months, and accordingly we will keep adding, right? Okay. So here we have first 3 months are 9,000. 9,000 into 3, 27,000. Then we have the next 3 months. Next 3 months will be 30,000. Next 3 months will be 11,500 multiplied by 3. That will be 11,500 multiplied by 3. I'm just taking random 3 months. Okay, then we will add it by, maybe we'll take 4 months, 5 months, like that. That is 34,500. Now add the 3 currently. 27 plus 30 plus 34,500. I get here 91,500. So that means my turnover crossed. My turnover is crossed at the end of that 3rd month. So which is that month? The period started in July. So July, August, September, first 3 months. October, November, December, next 3 months. January, February, March. So March end is when your turnover is exceeded 90,000 by historical test. Done. So December month your turnover got exceeded, and now what is the question requiring? What date? From what date will Damien have to charge output VAT on his sales? So what is the effective date of registration? Effective date of registration is first day of the 2nd month after the turnover is crossed. Turnover crossed at 31st March. The next month is April, leave that. The next month is May, take the 1st of May. 2nd month, 1st day. Okay, 1st May is your effective date. So my answer here is 1st May. 2 on 2. Next one. Sahia was born in Qatar and she is not married, does not have any children. Sahia relocated to UK in December 24 and moved in with her sister at her house in New York. With her house in York. Yes, is Yorkshire. Sahia has previously visited the UK for 95 days in each of the last 3 tax years. So there's a requirement for the last 2 tax years, that 90 days clause, remember? Right. And has never been a UK resident in the past. Which of the following statements regarding Sahia's UK resident status for the tax year 24-25 is correct? Now she relocated to UK in December 24. Your tax year ends on 5th April 25. So when you see the automatic UK overseas test, less than 16 not matching, less than 46 not matching, less than 91 days not matching. Okay, so less than 46 days is also not matching, right? So no, it is not matching. So no automatic overseas test are met. Let's see automatic residency test, because the first point is automatic residency test also. She doesn't have a home in UK. She's not there for 183 days or more, and she doesn't have a full-time work here. So automatic residency requirements are also not met. Let's go to the third one. The third one is where we see the manual test. Now she has never been the resident, but I want to take the help of a table. And for how many days she has been in UK this year? Assuming December full month, it's 91 days. And then we will see the other criteria. Yeah, then we have to see the other criteria. But when I see the options here, there is no need for me to count the days, because it is not asking me whether there is a resident or a non-resident. So let's read the question completely. Which of the following statements regarding Sahiya's UK resident status for the tax year 24-25 are correct? Okay, let's see the options and accordingly we'll do the working. Sahiya meets the automatic UK residency criteria. Wrong. Sahiya's close family in UK. Let's see. She has come here to stay with her sister. And sister is a close family? No. Close family is only the spouse and the children. And minor children, that too. So spouse, civil partner, minor children. As Sahiya is nothing. I mean, she's just she's staying with a sister who is not a close family. So B is also not correct. See, she meets the accommodation time. Yeah, she is staying in her house she's staying in an accommodation in York. So that meets the criteria for accommodation. So third is looking correct. Let's see the fourth one. She meets the automatic non-UK residency test. Again, not correct. So third is the correct answer. 2 on 2. Okay, I'm sure everybody is able to follow this. Now let's go to the next one. Jules resigned from her employment at initial entity on 31st August 24 and started employment with sequential entity on the very next day, that is the 1st September 24. Now, Jules had a gross annual salary of 40,000 with initial company. Her gross annual salary with a sequential company was 45,000. And they provided a company car also. So that is the P11D form. Remember, identify who will provide Jules with the P11D form for the tax year. Of course, as I told you, the one who provides a taxable benefit, that is the which entity is sequential. So sequential will provide it, and by when? By when it is to be provided? By 6th July 25. Remember the dates? If you don't remember, please refer back to my sheet that I've given to everybody free of cost, that is there on the Telegram channel. Entire summary at one place so that you don't forget these dates. Okay, 6th July 25. This is my correct answer. Okay, guys, let's go to the next one. On 15 June 2024, Celia sold an antique tea set for 8,700. The moment I see this, somehow shackles come to my mind. That 6,000 rule, non-wasting shackles come to my mind. Let me read further. The antique tea set had been inherited by Celia on the death of her grandmother in 2011 and was valued at 4250 at that time. So she inherited it at a lower price, but she's selling it at a higher price. So it is in that bracket where bought for a lower value, make it equivalent to 6,000, right? And then sold it at a higher value. Then we take 2 by 3. Remember? Sorry, 5 by 3. So remember that calculation? Yes, we'll take it now. What will be the chargeable gains arising on the disposal? The chargeable gains arising will be, you will be taking the sales value, which is 8,700, less 6,000 you will take as the inherited value is lower than 6,000, multiplied by 5 by 3. And you get here, so 8,700 less 6,000 multiplied by 5 by 3, I get here 4500. Again, I repeat, 8700 less 4250 because that is the inherited value, and the difference multiplied by 5 by 3. Either this gain or the actual gain, you will take the gain which is lower. Right? We take the lower gain. So these are small pointers, and that you need to be completely crisp on. Yes, we take lower only, not higher. Not everywhere we'll take higher. So remember the rules very comfortably. Okay? Because gains are always from the perspective of the taxpayer. So we will always prefer lower gains. Like this, you remember. Okay, anyways, the normal gains are 8700 less 4250. So 8700 less 4250 is 4450. Now you take 4450, 4500 that we calculated, which is lower. 4450 is lower, so your tax gain would be 4450. I'm sure you are clear. Great. Okay. Now the next one. Annie's husband Jake died on 18th November 2014. Under his will, he left his entire estate to Emmy. Okay. Emmy died on 25th May 24. Okay, so Jake died on 18 November. Under his will, he left entire estate to Emmy. Emmy died on 25th May and left her entire estate, including a main residence, to her daughter Andrea. That means, and Emmy will also receive RNRB of Jake. Don't forget that. Okay. What is the maximum RNRB that can be claimed at the time of Jake and Emmy's death? How much Jake can claim, but he left his entire estate to Emmy. So will he claim anything or will he not claim anything? And the question is on the RNRB, a residence nil rate band only. So it's, I think, pretty easy. Jake left entire estate to Emmy, not to the lineal descendants. So Jake will get 0 and Emmy will get 350,000. Pretty comfortable. Why? Because Emmy will get her own 175,000 plus transferred from Jake 175,000. So the answer is option 1. Next, Carrot Limited acquired a 20% shareholding in Dented Limited in 1st June 24. For the 6-month period that ended on 31st December 2024, Carrot Limited had a taxable total profits of 49,000 and received 4,500 dividend from dented entity. How much will be Carrot Limited's corporation tax liability for the 6-month period that ended on 31st December 24? What is the augmented profit? Because I need that level. Augmented profit is 49,000 plus 49,000 plus 4,500. That is 53,500. Don't jump to any conclusion because you have a period given only for 6 months. So remember, your limits will also be calculated for 6-month period. So your upper limit will be then 125,000, 250,000 by 2, and your lower limit will be 50,000 by 2, which is 25,000. Okay, so your upper limit is 125,000, your lower limit is 25,000. Now, when you see 53,500 AP, it is falling in between. So you just have to do normal calculation of corporation tax, reduce marginal relief. Since there is dividend, you cannot apply marginal tax concept. Okay, I'm sure it is clear. Okay, now let's do the calculations. So now corporation tax liability will be first at main rate. So you will calculate 49,000, which is the TTP at main rate, and you will get here 12250. Now reduce marginal relief, that will be upper limit is now 125,000. So 125,000 less AP, which is 53,500, multiplied by 3 by 200, a fixed fraction, and multiplied by TTP by AP. TTP is given to you 49,000 and AP is 53,500. Please do the calculation and calculate marginal relief. So 125,000 less 53,500 is 71,500 multiplied by 3 by 200 and multiplied by 49,000 divided by 53,500. I get around 983 as the relief. 983. Okay, 982 actually, not 983 because it is 982.28, right? So that is 982. So what we did, 125,000, that is a revised upper limit less AP, which is for 53,500. Difference multiplied with 3 by 200 and that multiplied by TTP by AP, which is 49,000 by 53,500. Okay, now when you multiply, you get 982. Reduce it from your tax that you have calculated at main rate. That will be 12250 less 982. And I get here 11268. 11268. So do we have this answer? Yes, we do have it. And this is my correct answer. Okay. Don't forget to prorata the limits when it is a short period or when they are associated companies. Don't forget that. Okay, let's go to the second last question of section A, which is tax limited voluntarily registered for VAT on 1st January 2025. Voluntary registration. During the year ended 31st December 2024, tax limited. Okay, that's the pre-period. So I think this question on what is the input VAT credit available. Okay, so remember for the goods last 4 years inventory and for the services last 6 months services. Okay, remember like this. Now tax limited paid input VAT of 230 monthly to an outsourced marketing team for their services. Tax limited also paid input VAT of 750 on the office equipment which was purchased in February 24. So February 24 and 1820 on a plant and machinery item purchased in August 24. Office equipment was scrapped in November 24. That is before registration it was scrapped, so you will not consider it. You will just consider the plant and machinery item, just like the goods input treatment that we do. So now here 230 is the monthly to an outsourced marketing teams. You just take last 6 months VAT, right? What is the amount of pre-registration input VAT that they will be able to recover? Do I have anywhere given that this is including VAT or excluding VAT? Nowhere given. But it is just asking me, okay, this is VAT only given to you, my bad. So you will take 230 into 6. 230 into 6, which is 6 months services. So that will give me 1380. 230 into 6 will give me 1380 because I will take 6 months service input VAT. Now for office equipment is the next input VAT that you will take. Why? Because it is within the last 4 years, before the registration date. So just like input goods, we will take input on capital items. So 1380 plus 1820 will give me 3200. So 3200 is the pre-registration input VAT that I will take. Only important point is, ma'am, why are we not taking office equipment? Because we need that item to be in inventory on the date of registration, which is not holding here because it is already scrapped. Since it is scrapped, it is not there. Hence, we will not consider the input VAT. Clear? Great. Let's go to the last question of your section A, which is Dean is employed as a senior finance manager. For the tax year 24-25, he received a salary of 75,000. Dean is a single parent. Okay. Dean is a single parent and he received child benefit of 2213 during the tax year. He has a salary of 75,000. We need to calculate first what is the adjusted net income, which is here the same amount only because there is nothing else. Since it is between 60 to 80,000, we will have the child benefit charge calculated. Which of the following statements regarding the child benefit tax charge is correct? But before I select, I need to do the calculation. Take the difference between what is excess over 60,000. Excess is 15,000. divided by 200. So what is the percentage that you are getting? 15,000 by 200 is 75%. Now take 75% of 2213 and that is going to be child benefit charge. So that will be 2213 multiplied by 75%. So that will be 1659.75. That is around 1660. So 1660 is my child benefit tax charge. Now let's see the option which gives me this answer B. So my answer is B, done. Clear? So we covered multiple areas in this section in debrief session of your pre-March mock for your tax paper. So stay tuned for the next video. We will have the discussion like this for section B. So stay tuned till that time and practice well, practice hard. And please do give feedback in the comment section. How was this video helpful to you? Did it provide any help to you? And also please subscribe the channel, like the video and stay tuned because you'll have lot of exam useful content is going to be made available to you. Thank you guys. Study well, study hard.